Thank you very much, Sid. I'm Don Van Deventer, and I'm going to start the session. So if we could go to the next slide, please. I'll do a brief overview, and then Bob Jarrow will do the heavy lifting on the theoretical front, and I'll close with a worked example that's based in recent events. Now, formally, we're talking about modeling of credit card advances and deposits in a no arbitrage valuation model with multi-factor yield movements and the possibility of default. So there's some common elements to the modeling of credit card advances and deposits. Both the interest rate and the balance are functions of open market interest rates. And when these rate and balance relationships happen to be linear, cash flows are a quadratic function of open market rates. So it's an exotic derivative that is something Risk Magazine loved when Bob and I first published there on this topic in 1996. Default risk is important, but in the case of credit card advances, it's conventional credit risk like Jens Hilscher, Bob, and myself wrote about in 2022 paper on corporate credit risk. The really fun and topical aspect that we're going to focus on today is the default risk of the bank issuer of deposits. And that determines when a retail depositor will exercise the depositor's put option to withdraw the balance at par value. So at this point, we need to go to the next slide, and I'll turn the baton over to Bob.
Thank you. So I'm just going to talk very quickly about the theory for modeling both demand deposits and credit card balances. Clearly, the first is a liability, the second is an asset, and they are very similar except for the sign, i.e. liability versus assets. And the big unknown here in modeling, as Don mentioned, is how the balances of each evolve over time as a function of the state variables, bank characteristics, and the state of the economy. Next slide, please. Now, let's talk first about non-maturity demand deposits. Clearly, the state variables of interest would include interest rates, the health of the economy, comparable investments, example, U.S. Treasuries, and as Don mentioned, very important is the credit risk of the bank. And clearly, because the deposits can be withdrawn on demand, if the bank's failure becomes an issue, despite FDIC insurance, deposits will be withdrawn. So in the modeling of the evolution of demand deposits, one needs to include the likelihood that the bank will fail. Now, once one has a good evolution for the deposit balances, then the arbitrage-free pricing methodology kicks in and one can compute a present value of the demand deposit balances. And this will yield an effective maturity and a whole array of risk management statistics. Next slide, please. Moving on to credit card balances, except for the sign, they are very similar. And one needs to, again, model the evolution of the balances as a function of state variables and the banks that issue the credit cards characteristics. Now, key here will also be the credit risk of the borrowers and losses due to fraud. But again, these can be modeled, and when one gets a good evolution, a model for the evolution, then one can apply arbitrage-free pricing methodology to compute present values, and such computations will yield effective maturities and risk management statistics. Now, before moving on to an example that Don's going to present, I want to emphasize that contrary to common perception, we do know how to model and price and risk manage non-maturity demand deposits and credit card loan balances. And to show you this, Don is going to provide an example where he models the evolution of the demand deposit balances in the current market environment. Next slide, please. And I'm going to pass the baton back to Don.
All right, Bob, thank you very much. One of the interesting things about analyzing deposit balance sensitivity to these key risk factors in the bank's own default risk is, what can I say, an almost all pervasive confidence among asset and liability managers of the biggest banks that if there is a banking crisis, it will be a crisis that affects other people, not them. And very common to hear people say, we will have a deposit inflow in a crisis, not an outflow. And one of the reasons people argue that is because most of the analytical work they've done on the deposit balance relationship involves their own history. And if the bank has never had a near-death experience, there will be no evidence that the default probability of the bank matters. So the key to success is modeling with data that includes the experience of banks that failed. So there are really two basic approaches. The first assumes that default probabilities are modeled as if they are exogenous, ignoring the link to the asset and liability values at the bank. The second approach, deposit probabilities are endogenous and a joint function of the value of assets and liabilities. We're going to work through an example of both methods in the brief amount of time we have left. The key point is that the interest rate risk protection that's offered by the deposit franchise is a function of asset and liability values. When assets are worth less than liabilities, the deposits have a value of par and are either withdrawn or retained. And no matter how high interest rates go, value stays at par if the deposits are still in the institution. So in the latter case, the effective duration goes to zero. And almost no one in the US banking industry has taken this into account in the modeling. So we're going to do that right now in a worked example. Next slide, please. Now, the perfect data set, if you're going to analyze deposit balance movements as if default probabilities are an exogenous variable, what you really want is a daily time series of deposit balances and deposit rates. And that kind of data exists, but it's available only to people inside the relevant institution and to regulators when they do an examination. Excuse me. So for illustrative purposes, we're going to create such a series. We're going to use the quarterly reports of condition submitted to the FDIC for Silicon Valley Bank. We're going to use their March 8K filing, March 8th 8K filing, and Federal Reserve's public comments on the deposit runoff at the bank on March 9th and March 10th. Now, you could use time intervals that are longer than daily, but given that Silicon Valley Bank failed in about 36 hours, and even during the savings and loan crisis, once the line of depositors came out the front door of the head office, those institutions only lasted for a week or 10 days. So if you're using long time intervals, whether it's a week or a month or a quarter, that information is not very useful in a fast moving crisis. And just to illustrate, I'm sorry, could you go back one slide? Just to illustrate how dramatic that runoff can be, according to the 8K filing for Silicon Valley Bank, the deposit balances were $165 billion at the end of February. But taking the Fed's comments on deposit outflow, the balances on a pro forma basis would have been only $23 billion on March 10th. Okay, now we're ready for the next slide. Now, there are a number of ways you could do the estimation of the balance relationship, and so let me tick off how accurately these approaches model the March 10th pro forma balance of $23 billion. Uh, Model 1, if you assume that deposit balances are random with a constant mean, you would have overestimated the balances by 142 billion. If you're assuming balances are a function of lagged balance amounts, capturing seasonality and things like that, you would have overestimated balances by almost 100 billion. If you did the conventional approach that most bankers are using, assuming balances are a function of lag balance amounts and short-term treasuries, you would have overestimated balances by 95 billion. Now, if you take the rational economic man and woman's approach to non-maturity deposits and assume balances are a function of lag balance amounts, short-term treasuries, and a function of the one-year default probability of the institution, that relationship errs on March 10th by only 18 million compared to these tens of billions of errors using the other approaches. And this is for our hypothetical data from October 1st, 2020 to March 10th, 2023. Next slide, please. Now, this is a graph of the 1 and 2 year default probabilities from our CRIS default probability service that are run along the bottom of the graph until the very end and then spike up into the upper right-hand corner. Since we're using quarterly reports of condition, we have kind of a step function for deposit balances. And then after the end of February at 165 billion, we have a $42 billion runoff on March 9th and the estimated $100 billion runoff on March 8th. And so the dark blue line is the fit of that best model to this hypothetical data. So this shows very clearly, even making the simple assumption that the default probabilities of the issuer exogenous, default probabilities matter in a hugely significant way if you're modeling the right data, not just the history of a bank that's never had a near-death experience. Next slide, please. Now we're going to take another approach, model default probabilities on a forward-looking basis or an endogenous basis. And so it's the normal bank failure process. Rates rise, government securities prices drop, commercial real estate prices drop, home prices fall, loans begin to default, asset values end up being less than liability values, and using the often stated, I want to be the first out the door strategy, deposits disappear and the bank fails. But just one comment before we go to the next slide. Even some very significantly experienced interest rate risk managers argue that it's totally irrational for insured depositors to flee in the face of the government guarantee of their deposits. The reality is they do flee because no one regards the US government as their first choice of a banking institution. They just move to another institution. And so that's the reality. And people have very good reason for not sticking around to see how long it takes the FDIC to make good on their promise to make them whole. Next slide, please. So this is a simulation we do weekly, published on kamakura.com every Sunday or Monday. We use a Heath, Jarrow, and Morton approach with 10 factors. We model treasury yields forward for 30 years, but we're only going to use the first 10 years of the simulation in today's conversation. We use 91-day time steps in the analysis, and we're using 500,000 scenarios. At each time step in each scenario, we do a couple of straightforward calculations. First, we calculate the market value of bank assets. Second, we calculate the market value of bank liabilities, recognizing that a fleeing depositor gets par value. And if the market value of assets is less than the market value of liabilities, then failure is recorded at that time step and that scenario ends. So the bank's default probability on a forward-looking basis simply involves counting the number of failures at each time step and dividing them by the total number of scenarios to get the bank's own default probability. Now, obviously, Silicon Valley Bank did not do this, or the CEO would have realized what you see on the next slide. What we have here is the cumulative default probabilities from buying one asset, a 10-year treasury, funded with deposits for varying amounts of initial equity. The top series of dots is the cumulative default probabilities for a bank with 5% cash equity. We're talking real cash, real market value for the equity, not any accounting measure of equity. The cumulative default probability in that case is 40.72%. The next layer of dots, the orange dots, is for a 10% initial capital ratio. Default probability is slightly under 25%. The green dots represent the default probabilities for 15% capital level. And I should add, Silicon Valley Bank was about 12% at the start of 2020. For 15% capital ratio, the default probability was 13%. And the final level is for 20% capital, a level very few banks achieve, and that's a 6% default probability. So what this says is there's no free lunch from maturity extension. We often argue that in a rational world, if you take one security worth $100, say a 3-month T-bill, and you sell that and buy another security worth $100, like a 10-year treasury bond, that creates no incremental shareholder value. And in fact, because it triggers a higher default risk, it ends up destroying shareholder value. And yet the management at Silicon Valley Bank and many, many, many other institutions believe that the stock price would go up if they took this maturity mismatch and that the shareholders would not realize what was happening. Next slide, please. So just to sum up our conclusions, correctly modeling a bank's forward-looking default probability is really the most accurate way to measure risk in the financial services industry. This requires a Monte Carlo simulation of the value of bank assets and liabilities in order to recognize the number and timing of default events. 3-scenario stress test does not cut it. Your only possible default probabilities would either be 0, 1/3, 2/3, or 1. And I think most bankers would like more precision than that. And obviously, we've invested a lot of time and energy over the last 3 decades building the capability to do this modeling. And it's delivered, simply and easily to clients with an interest of not being the next Silicon Valley Bank. And Sid, with that, that's all we had prepared on this topic for today.
Thank you very much. I think this is very timely and pertinent, if you will. And I think with that, we will move on to our next topic. And but thank you very much.
Thank you very much for listening.
Thank you.